Hello everyone. Today we are diving into the fascinating world of stablecoins, the bridge between traditional finance and crypto. If you have ever wondered why we need cryptocurrencies that don't fluctuate in price, you are in for a treat. Before we dive in, let's understand what makes a stablecoin stable. Unlike Bitcoin or Ethereum, stablecoins are cryptocurrencies designed to maintain a constant value, typically pegged to a real world asset like the US dollar. Think of stablecoins as digital dollars on the blockchain, combining the stability of traditional currencies with the speed and accessibility of crypto. Fiat collateralized stablecoins. Think of these as digital versions of dollars in the bank account. For every stablecoin issued, there is an equal amount of real currency held in reserve. Examples include USDT and USDC. Crypto collateralized stablecoins. These use other cryptocurrencies as collateral. Due to crypto's volatility, they are typically over collateralized. For example, you might need to lock up $150 worth of Ethereum to create $100 worth of stablecoins. DAI is the most popular example. Algorithmic stablecoins. These maintain their peg through complex mathematical algorithms and smart contracts that adjust supply based on demand. However, they face significant challenges as we saw with TerraCoin collapse in 2022. Cross-border payments. Imagine you need to send money to family in another country. Traditional banks might take 3 to 5 business days, charge high fees, offer poor exchange rates. With stable coins, you can send money in minutes with minimal fees 24 by 7 any day of the year. DeFi applications. Stable coins are the backbone of decentralized finance. They are used for lending, borrowing, and earning interest without the volatility risks of traditional cryptocurrencies. E-commerce. Online merchants can accept crypto payments without worrying about price fluctuations between the time of sale and settlement. Remittances. Workers sending money home to their families can avoid expensive wire transfer fees and long processing times. USDT, launched in 2014, largest stablecoin by market cap, backed by a mix of assets including commercial paper and cash equivalents, has faced controversy over transparency of reserves and past stability issues. Widely accepted across most crypto exchanges. USDC, launched in 2018, known for strict regulation and monthly audits, backed 100% by cash and short-term US government bonds. Popular in institutional markets. Strong focus on compliance and transparency. Consider these factors. If you prioritize liquidity and wide acceptance, USDT. If you value transparency and regulatory compliance, USDC. If you are an institutional investor, USDC. If you need most trading pairs, USDT. Regulatory uncertainty in different jurisdictions. Importance of reserve backing and transparency. Centralization risks with major issuers. Smart contract vulnerabilities for algorithmic stablecoins. The future of stablecoins looks promising with central bank digital currencies entering the space, increased regulation providing clarity, growing adoption in traditional finance, innovation in decentralized stablecoin models. That's your complete guide to stablecoins. Remember to like and subscribe for more videos. Drop your questions below and let me know in comments which stablecoin you like the most.